Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book How to Retire on Time, which you can grab today on Amazon or by going to www.howtoretireontime.com. My name is Mike Decker. I'm the author of the book How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to financial topics, we can pretty much cover it all. So that said, please remember this is just a show. Everything you hear should be considered informational, as in not financial advice. If you want personalized financial advice, then request your wealth analysis from my team today by going to www.yourwealthanalysis.com. With me in the studio today is my colleague, Mr. David Franson. Thanks for being here today.
Yes, glad to be here.
David's job is reading your questions, and I'm going to do my best to answer them. Now, you can send questions in at any time by texting them to 913-363-1234. Again, that's 913-363-1234. Or email them to heymike@howtoretireontime.com. Let's begin.
Hey, Mike, can you run through different ways you can invest in the market?
Yeah, absolutely. And this is probably a more timely question because when Goldman Sachs comes out and says, hey, we might have a flat market, there might be another lost decade for the next 10 years, I think people are waking up a little bit and thinking, maybe I shouldn't just default to the buy and hold strategy.
Yeah.
To answer the question, I want to divide up the camps of investment strategies into two theories. I think these two theories really summarize how to invest in the market. The first one is called relative return theory. And the idea here is that you're going to invest in the market and get a relative return of whatever happens. It's very passive. It's very reactive, which is not a bad thing. I know when we say, oh, don't be reactive, be proactive. When it comes to finances, sometimes it's okay to be reactive. Let the chips fall as they will.
Yeah.
So that's relative return theory. You're going to receive a relative return based on the portfolio that you've purchased. And I'll break those down in just a second. But I want to contrast the other theory. It's called absolute return theory. Now, that does not mean absolute guaranteed return. Okay. Absolute return.
Missed opportunity there.
Any economist or investor that can figure out how to absolutely guarantee a return is going to make a lot of money.
Yeah.
But no one's ever been able to do it. So no one will be able to. You can't. You have to be able to predict the future. I guess Biff from
Back to the Future.
Back to the Future, yeah. But his book only went so long.
Yeah.
So anyway, absolute return theory really it's defined as basically we don't care what the market's doing over a certain period of time. What has a high probability of growth? Like, how can we make money in the next 6 months? And what's the best place to put the money for the next 6 months? So it's not trying to time the market. This is a common misconception. It's not trying to time the market by going in the market or going to cash. Typically, absolute return theory would fall under looking for momentum or shifting portfolios based on certain indicators. And I'll break down those various strategies as well.
All right.
Here's the big takeaway. And I want to give it before I even explain all of this because we have so many cognitive bias. We want a certain result and want to think that we're the smartest person ever. And it's not that cut and dry. Every strategy, whether it's relative return or absolute return, has its benefits and its detriments. Whatever strategy you go with, don't pick it because it's what I'm used to. Think about it as, does it work within your emotional and economic limits? Okay, so emotional limits, can you handle the market going down? If not, what's the strategy that you're going to be okay with? And these aren't all-in strategies either. I want to clarify. Investing in the market, or what I'm going to be talking about, should be a part of your overall portfolio. I don't think a retiree should have all of their assets at risk. And we're talking about strategies where all of your assets are at risk. I do believe in the reservoir strategy where some of your assets are principal protected, whether that's in CDs, treasuries, money markets, fixed or fixed index annuities, or maybe you have some cash value, permanent life insurance, whatever it is. I don't care. But you have to have some protection. And bond funds don't count.
Okay.
Bond funds can lose money.
Yes.
And if you didn't know that, you probably recently realized that the interest rates are going up and bond funds were losing money. Okay. And by the way, now bond funds could be good to lower your overall risk because if interest rates go down, bond funds would increase in value. So it makes sense to have maybe some bond funds in your growth portfolio, but I digress. All right, let's talk about relative return strategies. So the first one I want to talk about is probably the most popular one. That's indexed investing. Everyone knows this one, right? This is Vanguard's like flagship, pun intended, product. But you can buy SPY or QQQ or VOO or whatever. You can buy an ETF that mimics an index.
Okay.
And you get the relative return of the index. And the index is a beautiful thing because, like, if you buy SPY or VOO, you're buying basically a little portion of 500 or so stocks in the S&P. So these are very large companies. They're not the largest companies in America. They're just handpicked for a various amount of reasons, but they're a prominent part of the American economy. If you believe in the American economy, you believe in its growth, you believe in the companies that are kind of within it, it's a very cheap and effective way to just buy and hold and get the relative return of whatever the S&P would do.
So is that like your Home Depots and your, I don't know, Coca-Colas or something like that?
Yeah. The big ones that are popular right now is NVIDIA, Microsoft, Amazon, Google, Tesla's in there. These are very common companies. And you can pull up a list if you're curious.
Right.
There's a few companies you're going, I never heard of that one before. And then you look at the companies that company owns and you're going, oh yeah, those guys.
Yes.
Got it.
Yes.
But the Goldman Sachs' suggestion that we could be in a flat market for the next 10 years would suggest that index investing might not make any money for 10 years like it did in 2000 or 1965 or 1929 or 1906. The markets, every 20 years, they'll go flat for 10 years or so, historically speaking. No one knows if it will happen in the future or when it will happen in the future. So that's the risk. Index investing, it's very low cost, but there isn't really a way to protect yourself for when the indexes go down. And if you're retired and expecting to have returns year over year to keep up with your income needs, a flat market cycle can really suffocate you. So you see how that works? I mean, if you're averaging, let's say 1-2% at best a year over a 10-year period of time, and you're trying to draw out 4% from your portfolio, you're going down the other way.
Yes. And
then you have to include sequence of returns risk where if you're drawing income from an account that's lost money, you're accentuating losses, making it more difficult to recover. Just for quick math, so you understand this, because this is a risk most people don't connect the dots on. If your accounts were to lose 30% in a market crash, it would be a 43% return needed just to break even, just to get back to zero. No growth, just to get back to zero. Now, if your accounts lost 30% in a market crash, which happens every 7 or 8 years, and you took out 4%, now you're down 34%. That means you would need a 50% return to break even. If you lose 50% overall, including the income, then you would need a 100% return to break even. The deeper you go down, the harder it is to recover. Relative return is a wonderful way to invest, but you need to understand the risks associated with it. That's why I talk about the importance of the reservoir. If you have some principal protected accounts that you can draw income from when markets crash, then index investing might be a suitable way to blend your reservoir, your principal protected accounts, and an indexed growth strategy together. That might work. And maybe it doesn't. That's the nuance of financial planning, but that's index investing and kind of how it would work in the retirement situation.
So if we juxtapose that with someone in their 30s or 40s, the market crashes, it's kind of no problem, right? You're not drawing income from it.
Yeah, well, I mean, David, let me ask you, when do you like to buy things? When they're on sale, right?
Yes.
So great. When the market crashes, buy.
Oh, right.
It's the same thing. The markets have recovered 100% of the time. So if your income is coming from your employment, then the market crashes are actually kind of a deal for people.
I see.
As long as you keep your job. And the joke is a recession is when your neighbor loses their job. A depression is when you lose your job.
Yeah.
You still have to be able to handle 3-6 months of unemployment. So hopefully that cash is in a savings account, high yield savings or something like that. But yeah, I mean, indexed investing, this is now my bias. Okay. Indexed investing is a wonderful option when you're looking at your non-qualified assets. Buy and hold, relative return. Don't create a lot of capital gains. Just let it ride. I think that makes sense. But if you're young and you're 30, let's say, and you've got some assets in a 401k, maybe you change jobs, rolling your 401k into an IRA and then buying the indexes, I don't know if that's the right play because you have opportunities to be more proactive with those funds. And we'll talk about that in absolute return. Okay. The other strategies for relative return, and this is how I categorize it, in my mind, dividend investing, which is a very popular thing. But you have to understand that dividend investing has risks. So during the Corona crash, as I've named it, I'm sure other people have called it that too, there were like 400 to 600 companies that just stopped paying their dividends. So dividend is fine, but if you're depending on your income from dividends, you don't want to be in a situation to where if enough of them stop paying and you have to now sell your dividend to make ends meet, then it's kind of hard to recover from that.
Yeah.
Dividend investing is a very traditional thing to do. It was more popular in the 50s, 60s, 70s, 80s when you couldn't actively trade or move things around. Lately, in my opinion, there's more stocks or equities, companies that are focused on growing their price as opposed to paying out dividends because we like the growth and we don't need the dividend necessarily. And then also you have to consider the tax inefficiency. So in your brokerage account, if you're reinvesting your dividends, you get the dividend, you still have to pay taxes on that dividend and then you reinvest it. That's not as efficient. And then when you think about dividend investing in the relative sense of it is what it is, and it's very passive, very low cost, you need to really focus on two things. One is the growth is the dividend being reinvested. Because dividend stocks don't typically grow very quickly. And then the greater the dividend, the more the risk. So I hate leading conversations. This is so leading, but just bear with me for a second, okay?
Sure.
At least I'm calling it out.
Yeah.
Okay? Because I'm not trying to sell you a bond right now or a dividend stock, but I need people to understand this. So many people come to my office and say, look at my dividend portfolio. I got the best ones. I found the secret positions. No, you didn't. You just took a little bit more risk than you may realize, which is fine. Mm-hmm. But are you comfortable with the risk? Are you aware of the risk? Okay, so let's say you've got one stock that's paying a 2.5% dividend with not much growth. And then you've got another stock that's paying, let's say, 5% dividend with growth, or bond that's paying 5% coupon rate. Which one would you prefer? Well, 5%'s better, right? All right, well, David, what about 7%?
Yeah.
10%?
Keep going.
At some point, you go 15, 20, 30%. At some point, everyone starts to say, what's the catch?
Okay, yeah.
The problem is people will let greed blind them to the maybe 7, 8, 9, 10%. Oh, this is fine. And we rationalize it. And then we don't realize we're buying a bunch of Toys R Us bonds, which for those who didn't realize, if you haven't noticed, Toys R Us isn't really around anymore.
No.
Certain situations don't always work out. So when I look at a portfolio, you look at the classics, like Chevron is a classic dividend stock. The position's probably not going to grow, but I think it's paying like 4 or 5%. It's usually somewhere around there. Great. But you're going to pay taxes on the dividend, whether you need it for income or you reinvest it, which is fine. If it's within a qualified account like an IRA or a Roth, you won't pay taxes on the dividend, but you'll pay taxes when you pull out the funds. It's just a different way to invest. Is it better or worse than indexed investing? Who's to say? And you even buy the S&P 500, you're going to get some dividends as a part of it anyway.
I see.
So again, who's to say which is right? This is now more of a conversation of opinion, not confirmation bias, but here's how it works. Here are the benefits. Here are the detriments. Which one are you more comfortable with? And then here's my other, in the broad spectrum of categories of relative return, it's not indexed investing. It's I call it sniper investing.
Okay.
This is the Warren Buffett situation.
Being more precise.
Buy good companies.
Yeah.
All right, David, name 5 companies that you think are just good, solid companies that probably won't go anywhere anytime soon.
Apple.
Yeah. I don't think Apple's going anywhere anytime soon. What else?
Walmart.
Yeah.
Toyota.
Yeah.
What am I at? 3? I've got 2 more.
I mean, but do you see, these are companies you're familiar with.
Yes.
You believe in them.
Sure.
Okay.
Yeah, I'm a customer of all those.
So maybe you buy the stocks that you understand, you're familiar with, and you believe the company will continue to grow.
Yeah.
I love the story of the janitor up in the Northeast that was secretly a multimillionaire, and all he did was just buy companies he understood, reinvested the dividends, or if they didn't have dividends, they just grew. That's a way to invest. And then as you grow the positions, if it's in a non-qualified account like your brokerage account, you can slowly divest them if they're growth positions under long-term capital gains, which is favorable based on current tax law. Or you might just live off the dividends because you picked stocks that you preferred and you were reinvesting the dividends to grow your portfolio, and then you retire and you start taking the dividends. I want to highlight, though, do you see how neutral I'm being about the conversation? They all have benefits and detriments.
Sure.
It's just how do you blend things together? Now let's talk about absolute return. The reason why I want to highlight absolute return is it looks fancy. It feels fancy. You feel smarter when you're saying, I'm doing a sophisticated model. Yeah. And I'm making fun of myself because we believe here at Kedrick in absolute return models, but it's not for everyone. It's just different. So I don't want to come off and push anything harder than the other. So absolute return, which you're going to find commonly in hedge fund or with many of the money managers who have like a $3 million start. You have to have $3 million just to get into the fund.
Ooh.
Absolute return, as I've seen it, is more of a quantitative algorithmic situation. It's following a formula or a system that looks at positions in the system's objective way. And I say objective because the formula it's a theory, and looks to buy positions for a certain period of time. A trend following model.
Okay.
Where's the trend? Here's an example of one of our models. Okay, take the S&P 500. Do you think all the stocks are really growing at a good rate? Do you think they're all gung-ho, let's go?
Like out of all 500?
All 500 are really growing right now.
They probably that would be great, but probably not.
No, it almost never happens, right? Yeah. So what if you had an algorithm that says, here are the 500 stocks. Maybe let's quantify their momentum, their current price, their price earnings, and a bunch of other factors, put them on a scoring system, and pick, let's say, 10 or 20 of them that have the highest probability of growth over a predetermined period of time. Maybe it's 45 days you're going to hold it. Maybe it's 60 days. And then you reassess after that time period. That's how some of our absolute return models would work. Okay. Our Kedrick models work. It's a different way to think about it. We're not trying to time the market. We're looking for getting rid of inefficiencies and seeking efficiencies, or what really is growing right now. And some years, the trend is very difficult to find. Like this year, it was really difficult to find because the markets were going up and then they went down really quickly and then they went up really quickly. That messes up the system. That's called whipsaw.
Okay.
So if the markets are trending up, it would be more efficient, or should be more efficient, in the growth. If the markets are going down, it might be more efficient and maybe saying, hey, maybe we should put some in cash because we're trending down and cash has higher growth potential, like BIL, B-I-L. It's a fun little ETF for a time being, right? It can find things in trends. But if it's going up, down, down, up, that's hard for that. That's the weakness of the models. There's no such thing as a perfect investment product or strategy. This is a strategy we're talking about.
I think I followed that.
Do you think I covered it? Okay.
Yeah.
So that's trend following. Those are the ones that we typically do for our more aggressive clients, or the clients that want to be in a more sophisticated situation. They're okay with the ups and downs and maybe some quick turns because they have their reservoir built out. They've got other things kind of peppered in. Sometimes they'll do some of our models and some of the indexed relative return strategy. You can blend these things. The other ones for more absolute return, in my definition, you can do your more fundamental analysis. So, hey, this company is priced lower than we believe it should be. We're going to buy it for this period of time. We believe it's going to grow. And that's kind of the same idea. Michael Burry, the Big Short guy, he's more of a fundamental guy. And then tactical is charting. I won't dive too much into tactical, but that's trying to figure out how to buy based on charts.
Okay. Yes. Yeah. I glazed over it.
It's just, these are all different ways to kind of go about it.
Yeah.
But the idea here is nothing's perfect. They all have detriments, but find the ones that you can work within. So you're okay with it emotionally and economically. It works in your time frames, and stick to it. It's not always going to be perfect. Every model is going to struggle in certain periods of time. Every strategy is going to struggle during certain periods of time. The trick is not switching your strategies all the time. It's being consistent with your strategy. Pick a system and stick with it, and kind of ignore the sentiment, the emotions that can compromise your ability to be consistent. I swear half of investing, especially in the market, is a hubris exercise. It's trying to control your emotions and stick to the system.
Yeah, what's the saying? Like, you can't change horses midstream.
Yeah, you want to pick systems that are going to work in up markets, help protect in down markets, and be able to potentially make money even in a flat market cycle. And you're not guessing or winging it along the way. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcasts. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.